and welcome to FTI Experts Hub, CP's quarterly podcast series with FTI Consulting specialists. I'm Laura Valean, Senior Editor with CPE, and as usual, I'll be your host. In this episode, we're diving into a topic that's becoming increasingly relevant in today's market: why property valuations can diverge, and what that means for you as an investor, lender, or owner navigating a more complex economic environment. Joining me today is Mark Dunec, co-leader of Real Estate Valuation Services at FTI Consulting. With more than 2 decades of experience across valuation, underwriting, and capital markets, Mark brings a deep understanding of how real estate values are formed and why they don't always align. We'll explore what drives differences in appraisals, how standards shape credible valuations, and where property values may be heading in the current U.S. market. Mark, welcome to the podcast. It's great to have you back.
Thank you so much for having me.
So let's dive right in, because I know that in theory, two appraisers valuing the same property should land more or less within the same range or a very narrow range, right? Why are we seeing more divergence in practice today?
So firstly, I would say we see divergence in values, I would say primarily in a litigation setting, because in a non-litigation setting, there's only one appraiser with one opinion of value.
Right.
The users of the appraisal report is really often limited to the client, maybe the client's investors, lender, auditors, maybe even the IRS. But again, there's no opposing expert. There's no opposing appraiser looking at that individual's work. So on a high level and in a litigation setting, the appraisers are either, and this is what I see, they're solving for a different problem, or they're using unrecognized valuation methodologies, or they're concluding to assumptions that are not market supported.
So you seem to be making an important distinction between a certified appraiser and other real estate professionals offering just their opinions of value. Why does that distinction matter more in today's market?
So your question literally hits the nail on the head. So if you have a health issue or a dental issue, you would go to a doctor or dentist. If you have a legal issue, If you have a legal issue, you'll call an attorney. If you have an accounting or tax issue, you're going to engage a certified public accountant. Well, the same is true if you need a real estate value. Who you're going to engage? A real estate appraiser. A real estate appraiser is state licensed professional that's required specific real estate appraisal education. They require specific real estate appraisal experience to be a state certified general real estate appraiser. And again, there are many other professionals working in the real estate industry, right? There could be asset managers, property managers, brokers who represent buyers and sellers of real estate, brokers who represent landlords and tenants, real estate attorneys, loan officers, mortgage brokers, developers, investors, accountants, tax professionals, etc.
Almost everyone.
In the real estate industry, consultants who service the real estate industry, but none of those real estate professionals are licensed to opine to an opinion of value. And with respect, other real estate professionals are not educated or trained in the real estate appraisal process, which often leads to divergent values. Let me just share a quick example, if that's okay.
Sure.
Currently, right now, working on a litigation case where the subject property is an office building and it's 92% vacant. Round numbers, my opinion of value was $40 million. It was a market value, current market value, and the opposing expert was a certified public accountant. That individual also held a business valuation designation, but again, he was not a licensed appraiser. And he valued the property at $150 million, assuming the property was stabilized. And of course, as I just said, it was 92% vacant. And in deposition, he was asked if a buyer would acquire a 92% vacant office building, assuming it was stabilized. And he said yes. We'll do another podcast in a year if you would like, and I'll let you know the outcome of this case.
I'm really curious about it. So basically, people who need an appraiser should get one that has the USPAP license, right? So for listeners who may not live in the appraisal world, what is this? What is uniform standards of professional appraisal practice, and why is adherence to it so critical for credibility, especially in this economic environment?
Oh, what a wonderful question. So firstly, following USPAP is critical and required in all economic environments. USPAP is a set of generally recognized ethical and performance standards for the appraisal profession. Compliance is required for state licensed, state certified appraisers. And the purpose of USPAP is to promote and maintain a high level of public trust in appraisal practice by establishing requirements for appraisers. Now, adhering to USPAP is required because it ensures credibility and reliability by establishing minimum standards for development and reporting of appraisals across multiple asset types. And this consistency helps ensure that appraisals are able to be trusted by everyone, from clients, legal entities, and financial institutions. And again, there is a real estate appraisal process when developing and reporting an opinion of value. And just to drill the point home from your other question, other real estate professionals are not educated and trained in the appraisal process, and that leads to divergent values.
And in a recent article you wrote, you argue that incorrect problem identification is ground zero for valuation discrepancies. Can you explain what that means in practical terms?
Of course. So, in practical terms, if two appraisers are appraising the subject property and one is using current value, whereas the other appraiser is using a different date, maybe in the past, or a prospective value sometime in the future, obviously there would be two different values. Maybe an appraiser is utilizing market value and another appraiser is using investment value, again, a different type of value. Therefore, the values will be different. And again, the first step in the appraisal process is understanding the six problems. It's problem identification. It's the six problems or six questions that need to be answered before you could even prepare a scope of work. And just to go very quickly, who's the client and the intended user of the report, right? Who is going to be relying on the report? Is it the IRS, maybe the lender, investors? Is it a judge or jury? Is it only the client? And I would argue that values should not change, irrespective of the client or the intended users. So problem identification number one is identifying the client and intended users. Number two, it's what is the intended use of the report, which means what's the purpose of commissioning the appraisal in the first place, right? Is it for underwriting purposes, maybe estate planning? Is it litigation, property tax appeal? Again, I would argue that values should not change, irrespective of the intended use of the report. And as I mentioned already briefly, number three deals with the identify and the type and definition of value. You could have market value, investment value, insurable value, assessed value. And now the different types of values I just said could lead to a divergent values. I already mentioned the effective date of value. Is it a current value sometime in the past, a retrospective value, maybe a prospective value sometime in the future? And clearly different dates should result in different values. We have to identify characteristics of the property, meaning what are you actually appraising? Is it office, retail, industrial, maybe multifamily, vacant land? What's the size of the property? How many tenants there are? And then last but not least, there are two assignment conditions that an appraiser must identify within the report, which includes extraordinary assumptions or a hypothetical condition. And again, long story short, it is very critical, or I would say it's the most critical point. Step one is understanding these six questions that need to be asked, and the appraiser needs to ask the client or the attorney for the relevance of some of these answers, and these are the six identification problems.
You said earlier there's a clear distinction between market value, investment value. How often do valuation differences stem from confusion between the two? Why is that distinction especially relevant right now?
It typically happens in a litigation setting. And just for everybody who's going to listen to this, and just very quickly, the definition of market value is the most widely accepted components of market value are incorporated in the following definition. What is the most probable price as of a specified date in cash for which the specified property rights should sell after reasonable exposure time in a competitive market, with the buyer and seller each acting prudently, knowledgeably, and for self-interest, and assuming that neither is under due duress. And investment value is the value of a property to a particular investor based on the investor's specific requirements. Investment value depends on a set of investment criteria that are not necessarily typical of the market. So let me give another example. Litigation case I worked on, the subject property was 75 acres of vacant, unentitled land located in Albany, New York. I provided a market value of $2.5 million, and the opposing expert claimed to have provided a market value of $100 million. So
How
long
is that
story
even
short,
possible?
it's wild, wild west. Long story
Exactly.
short, the opposing expert adopted the client's vision for the property and provided essentially an investment value. So he said he included a market value, but what he did is he just literally accepted all of the assumptions of his client and said, no, this is market value. And there is a judge ruling out there, and the judge ruled 100% with my value.
Yeah, that's not surprising. Yeah, but sometimes even when two professionals are certified and USPAP compliant, values can still differ, even if only slightly. What are the most common reasons you see for that? Is it just their experience, the client pressure, data interpretation, something else?
What a great question. I would say either one of two things are happening. Either number one, they're solving for a different problem. For example, as we stated, if you have a different effective data value or a different definition of value, you should have different values, ultimate values. But let's just say we're actually solving for the same problem, right? We're solving, it's the same market value, same effective data value, it's a current value. So what am I seeing? Unfortunately, sometimes appraisers are using unrecognized valuation methodology. This is where an appraiser has created, I'm not kidding, their own valuation methodology that was not peer-reviewed or accepted within the appraisal industry. So let me give an example. Another case. I worked on an eminent domain case in New York City. And just for your viewers, eminent domain is the government's legal power to seize private property for public use, such as a highway, a school, utilities. In this case, there was a partial taking, which means the government entity acquired only a portion of the property. And there are a sequence of steps appraiser must take. And again, just to get, this is not exact, but just giving a high level, imagine you have a 2-acre vacant land parcel where the government is acquiring half an acre. So step one is you have to value the entire 2-acre parcel. Step two is valuing that small part taken, assuming it's 0.5 acres. And step three is just arithmetic. You subtract the value of the whole from the taking. And the remainder is 1.5 acres. So there is an appraisal process, a sequence that we must follow. Well, the opposing expert didn't do that. The opposing expert the opposing expert valued the remainder, the 1.5 acre parcel, independently without following steps 1 and 2. And because of that, not following recognized valuation methodology, not following the appraisal process, we had divergent values. And this case, I mean, even though it's settled, I would simply say it settled much closer to my value than the quasi-governments, actually meaningfully closer to mine than the opposing expert. And it's because I believe that the opposing expert did not follow the appraisal process. Another thing that I see often is they're utilizing incorrect valuation methods. So for example, in the income capitalization approach, you have two techniques. You could use the direct capitalization approach or the DCF, better known as the discounted cash flow. And again, the appraisal body of knowledge provides guidelines for when to utilize each method. Again, just give you a lot of work I do is in litigation. So here's another litigation case. Industrial portfolio, a bunch of buildings, multi-tenants, staggered lease expirations, and some of the buildings had vacancy. So the appraisal body of knowledge provides guidance, and they say when there's uneven cash flow, you got to use the DCF method, which is what I did. The opposing expert utilized the direct capitalization approach, which only analyzed 1 year of cash flow. And this approach didn't take into account rollover, CapEx, for example. And this is why our values were completely different. I'll just give one more example. In the sales comparison approach, identifying a reasonable search criteria for whatever one is valuing drives the ultimate value. So if one has an unreasonable search criteria to begin with, obviously the values will be different. And the way I start my sales comparison approach, I go narrow and I expand my search until I've identified enough comparable sales to conclude to a market-supported opinion of value. And again, let me just give an example. There's a subject property, 500,000 square feet of Class A office building. It's located in Midtown New York City, and they data value, let's just say, is today. In the perfect world, I would find 5 to 10 sales of approximately the same size, this 500,000 square foot Class A office building in New York that, let's say, sold in the last 6 to 12 months. I would never utilize a 50,000 square foot office building. Like that just would not be comparable. And what I've seen in litigation is sometimes appraisers are using comps that are just clearly not comparable. And again, I'm giving an extreme example, but I've seen extreme examples.
They happen in real life, so you work with that.
No, right. It's not, that's correct. And I would say the most common error that I see are when appraisers are providing unsupported assumptions. So for example, an appraiser conclude to a cap rate or a discount rate or a market rent or whatever they're going to be concluding to, but they don't provide market support. And every assumption, every concluded assumption within every appraisal report must be market supported.
Right. And then we've been living in this higher for longer interest rates environment for a while now. Tighter credit, shifting fundamentals. How are all these things influencing appraisal outcomes across asset classes?
You know, persistently higher interest rates have increased the cost of capital. You know, this is forcing investors to demand higher returns. This translates, and we see it, to higher cap rates, which directly depresses property valuations. In terms of tighter credit and lender caution, you know, what I'm seeing is stricter underwriting standards, lower loan-to-value ratios, higher debt service coverage ratio requirements. And again, it's making it difficult to support peak pricing. And in terms of shifting fundamentals or fundamental valuation with transaction volumes low, appraisers are relying less on comparable sales and more on the property's current NOI, net operating income, and future income potential.
Would you say we're in the middle of a structural reset in commercial property valuations, or is this still cyclical repricing?
What a great question. It appears that commercial real estate sector is experiencing a profound structural reset, not merely a temporary cyclical repricing. Again, while interest rates triggered the initial repricing, the ongoing shift is defined by permanent changes in tenant behavior, hybrid work, and AI-driven space efficiencies, particularly in the office sector. High-quality modern assets may stabilize while aging commoditized properties appear to face permanent devaluation.
For owners approaching refinancing or recapitalization, what is the biggest mistake they can make when commissioning a valuation today?
Make sure appraisers are not relying on outdated, unverified, or improperly normalized financial data, which fails to reflect current market conditions. Don't assume past growth rates will continue without accounting for shifting interest rates. Industry trends or economic downturns can lead to overvaluation. And I would say it would be inappropriate to assume a 3% revenue and expense growth assumptions for all assumptions. And I'm seeing it over the years all the time. They're just, unfortunately, my colleagues are just saying, okay, revenue growth and assumptions are at 3%. And I don't know why they're doing that. And just to give an example, the last several years, we know insurance and utilities have grown more than 3%. So
Right.
why are my colleagues around the country using 3% expense growth? I'm not.
Good. What should investors and lenders be doing now to reduce the risk of appraisal surprises?
Such another good question. Ensure their own underwriting concluded assumptions are based on market support. It goes back to your previous question, right? Making sure that investors and lenders are also not relying on outdated, unverified, or improperly normalized financial data, which fails to reflect current market conditions. Don't assume past growth rates will continue. And again, it's inappropriate to use 3% revenue and expense growth for all assumptions.
Are you seeing more valuation volatility in certain property types, office, hospitality, development assets, healthcare than others?
Yes. There is definitely valuation volatility. And what I'm seeing, it's primarily in traditional office. Office valuations are experiencing, unfortunately, significant declines, some as such as 50% from recent peaks. But again, we're talking about older properties. So if you have brand new trophy buildings, Class A buildings with top tier amenities, they're stabilizing, but the older commodity office assets in urban centers like Chicago, Denver, even DC are at risk for functional obsolescence. And in terms of development assets, we're witnessing high volatility to increased CapEx, high construction costs. There's immigration restrictions, as we know, long delivery timelines. Again, rising debt costs have squeezed profitability.
One last question, Mark. If you had to look ahead to later in 2026 or late 2026, where do you see property valuations trending in the US? What variables will matter most?
Wow. I got to think
Hard
about
one.
that. That's a really good question. Again, I don't have that magic ball, but let's just go with gut,
Nobody does,
right?
yeah.
Multifamily, I expect rent growth will likely be soft or flat as it relates to industrial. We just came off the pandemic boom. Valuations are stabilizing as supply and demands are rebalancing. Demand for specialized last mile logistics facilities do remain strong. As I just mentioned to office, it really depends. If you have these brand new Class A trophy assets, they're doing really well, but some of the older properties are becoming obsolete. Retail, surprisingly, are doing well. Think about grocery anchored or suburban neighborhood centers. Again, there's limited new supply, and that's driving demand and overall NOI to retail properties. I'm going to remain silent as it relates to data centers because I do think that the jury's still out on that. But again, you asked, I believe, what are the key variables driving it, right? It's obviously going to be interest rates, it's going to be inflation and wage growth.
Okay, we'll see about that. Thank you so much, Mark, for all these insights and clarifications. And I look forward to speaking with you again soon.
Oh, wonderful. Thank you so much. I appreciate it.
That's all for today's episode of FTI Experts Hub. If you enjoyed this conversation and want to hear more insights from CRE industry experts, Make sure to follow CPE podcasts on your favorite platform. That's where you'll find all of Commercial Property Executives' podcast series, including FTI Experts Hub. You can also stay up to date with the latest news, trends, and analysis at cpexecutive.com. Thanks again for listening. Till next time.